Most wheel traders think they're running a safe income strategy until the moment their capital gets locked up and they realized no one warned them about the trap they just stepped into. And here's the crazy part: almost every YouTube instructor teaching the wheel hides this flaw because they never show real results through market downturns. In this video, I'm going to show you 3 things every self directed wheel trader needs to understand. Number one, the new, safer, modern concept that prevents wheel capital lockups. Number two, how you can trust it to hold up even when your stock craters. And number three, and how this approach actually keeps your capital compounding instead of sitting dead for months or years. If you've ever felt like the wheel should work but keeps turning against you, this video will finally show you why and the modern fix that makes the strategy actually work in real markets. Now, who am I? I'm Karl Domm, and I've shared my Real P&L on YouTube since 2019 through the 2020 crash and the 2022 grind down and every market condition since. And across all my accounts combined, I've not only been profitable every year, I've outperformed the long-term average of the S&P 500. So let's cut through the hype and get to the truth. Now let's start by answering one big question. What is the new, safer, modern concept that prevents capital lockups when trading the wheel? Well, every wheel trader thinks the danger is the strike they choose. But what if the real danger is something they never even knew to look for? Why does the wheel work great for months and then suddenly trap traders for months or years? When I first started trading options, I made the same mistake most wheel traders still make today. I thought the job was to pick the right stock and sell premium consistently. But year after year, I ran into the same problem. Everything looked great until my stock dropped. And the moment it dropped, the entire strategy flipped. I wasn't collecting income anymore. I was babysitting a losing stock position and praying for it to come back. It felt exactly like trying to push a car uphill with the parking brake halfway on. You can move it a little, but the drag just never stops. Back then, when I was trading like this, I assumed the fix was to roll earlier, or choose better companies, or pick safer deltas. It turns out none of that mattered. I could have chosen the safest stock in the S&P 500 and the result would have been the same, because the flaw isn't my picks, the flaw was the structure. The wheel doesn't break from bad picks, it breaks from being unhedged. And when the stock drops, you're pushed into assignment and you're instantly underwater. An assignment is not the problem. Being forced to hold a falling stock is the problem. Once assigned, premium dries up at your strike, your capital freezes, there's no compounding, and there's no flexibility. The real fix isn't rolling, it's preventing assignment from being the pressure entirely. And this is where the modern concept comes in. The fix is simple: always be hedged, but not overhedged, not hedged with expensive wings, just a small, systematic, low-cost hedge that does one thing. It keeps forced assignments from trapping your capital. This one change transforms the wheel from a capital locking trap into a modern, safer income structure that actually works when your stock tanks or the market plummets. But here's the question every skeptical trader will ask next: does this safer concept actually hold up when my stock craters? Later in this video, I'm going to get into the details and show you exactly what happened in an example to Lulu in 2025. It's one thing to understand a safer concept, but here's the real test. What happens when your stock absolutely craters? Because you've been trading long enough, you know this truth. Every strategy works in calm markets, and only a few survive the violent ones. And this is where your skepticism kicks in, and it should. Now, I learned this the hard way. I was following the popular trading education at the time: sell premium, trust the probabilities, write it out. And for months, everything looked fine until one earnings season when 3 of my positions dropped back to back. Suddenly, everything I thought was safe income turned into a slow motion wreck. It reminded me of those old carnival rides where the floor drops out unexpectedly and everything feels stable right up to the moment that it doesn't. And that's exactly how the wheel works without protection. It feels controlled until volatility yanks the floor out. And back then, I did exactly what most wheel traders do today. I rolled, I waited, I hoped. I told myself the stock will come back. But that's the trap. Hope is not a strategy, and a stock can stay underwater far longer than your account can stay tolerant. The real mistake wasn't the stock pick, and it wasn't the delta, it wasn't the strike. The mistake was being unhedged in the first place. A stock crash exposes whether your system is real or just theory. If the entire strategy collapses under pressure, it was never safe to begin with. You can't judge a strategy by its winners alone, only by its worst case scenario. A modern system must survive sharp drops without freezing up your capital. Hedging isn't about avoiding losses, it's about avoiding being trapped. A small hedge can control bleeding and your capital stays liquid. Without the hedge, you're going to get a deep drawdown and your capital could be locked up for months or years. Now, in my last video, I backtested Lulu with the wheel strategy. And here's scenario number one, Lulu in 2025 and the capital trap. So a trader sells Lulu put at $415 at the $415 strike early in 2025. The stock drops. They get assigned, and now they're stuck in a position that bleeds deeper each month. So you have over $40,000 trapped. Your stock, it goes from 415 down to 217. Covered call premium at the 415 strike disappears. And there's no premium to collect, there's no rolls available, and there's no exit without a massive hit. With Lulu, they would have collected around $3,200 across multiple cycles, but they're down over $21,500 in unrealized losses. And here's what most people miss. They may be stuck for years before Lulu ever comes near $415 again. And that's the wheel trap. When your stock craters, it shows up every time. Now watch what happens if you run the same Lulu position with the modern fix. Always be hedged. Not heavy hedging and not hedges that eat half your premium, just a small, efficient, long put or put spread. When Lulu collapses, your hedge absorbs the blow. Your downside is limited. You exit early. Your losses stay small and your capital stays available. Instead of $40,000 worth of capital sitting dead for months or years, you can move on immediately, take a small hit or even a gain with a hedge. You can redeploy into a better setup. You can keep collecting premium and keep compounding. And this is the foundation of ABC. Always be collecting. The hedge is the key that unlocks the capital and keeps the wheel moving even when the market turns violent. Stop relying on unhedged wheel positions to survive market drops. The fix is simple. Always be hedged. And this one change ensures your capital stays liquid, stays flexible, and ready to keep generating income, even when your stock collapses. But there's one more question to answer. Even if hedging protects you during a crash, does it actually keep your capital compounding over time? So here's the question that matters most. Can this safer, modern, structured approach actually keep your capital compounding, or does it just delay the inevitable? Every trader knows how to make money when the market's calm. But the real skill, the one almost no one masters, is keeping your money working when things fall apart. And that's the difference between a hobbyist and a professional. So when I first began structuring systematic strategies, I noticed something strange. No matter how good the entries looked, no matter how safe the stock seemed, no matter how high the win rate was, the problem was never the trade itself. The problem was the moment a position froze my capital. It felt exactly like running a business where half of your revenue stream evaporates overnight. You can't scale, you can't reinvest, you can't compound. You're surviving, not growing. Hold that thought because this is the exact experience wheel traders run into every year. I used to make the same mistake most wheel traders still make. I waited. I waited for the stock to recover. I waited for the premium to return. I waited for the charts to come back to normal. But waiting is not compounding. Waiting is stagnation in disguise. And waiting is exactly what destroys compounding. Compounding dies the moment your capital gets stuck. A trader underwater isn't just a losing trade, it's months or years of lost opportunity cost. The wheels True danger isn't assignment, it's immobility. Once your capital freezes, you can no longer trade new cycles. You can no longer collect premium. Your equity curve flattens or drops. Hedging replaces stagnation with continuous cycles. A small hedge unlocks your ability to close early, move on, redeploy your capital, and keep stacking cycle after cycle and keep collecting premium. This is what creates long-term compounding. So let me show you the difference visually using the 2025 data from Lulu. The unhedged, you're assigned at 415. The stock collapses to 217. Your capital, $40,000 plus, is locked up. Your premium collected is around $3,200, and your unrealized loss is over $21,500. And you have zero cycles for 6 to 12 months. No way to compound and no way to redeploy the capital. Your account flatlines. Now, let's see if you run the hedge system, what happens? What happens if you run the wheel with a hedge? The hedge absorbs the volatility shock. Losses stay small, or you actually can have a gain. Positions are closed early. Capital is freed instantly. You can run 10 to 15 new cycles during the same time frame. Each cycle adds premium. Each cycle has the ability to compound your money, and you'll have an equity curve that continues to grow while the unhedged trader is frozen. And this is the difference between a stalled engine and a compounding machine. If you want your capital to actually compound, not occasionally grow and then freeze for months, you must always be hedged. Because hedging isn't about avoiding losses, it's about avoiding stagnation. And a trader who never stagnates will outperform a trader who sits stuck waiting for a stock to recover. And that's the modern wheel. And that's how you keep your account growing year after year. But here's the part almost no wheel trader ever stops to question. Even with hedging, you're still anchored to the same assumptions that quietly sabotage accounts. And the truth is, everything you've learned up to this point becomes irrelevant if you're still operating under these false beliefs. Because once you see what's actually happening beneath the surface, those assumptions don't feel so safe anymore. In the next video, I'm going to break down these misconceptions, the patterns almost every wheel trader overlooks, and why it always appears at the exact moment they think they're in control. Go ahead and click the screen to watch the next video called Most Wheel Traders Fail Because of These Myths, and here's the new simple way to avoid them and stay safe. You'll understand why this matters the moment you see it.